Good morning, friends. Today we have while my video series 77, we discussed current liabilities. With that, we have completed the discussion of equity and liability side of a balance sheet. Now, while this video series 78, let us start our discussion on the asset side of a balance sheet. On the liability side, basically we have three things. One is an equity, non-current liability and current liability. But on the asset side, we have brought two clarifications. One is non-current assets and current assets. See, non-current assets, the asset side of the balance sheet also have got 1, 2, 3, 4, 5 columns. First one is a number, second one is a particulars. The third one is a note number where you can go, if you want to know more about a particular item, you can go to this particular note and understand that one. The next one is the figures as on the current period. Last column is corresponding figure of the last previous reporting period. So as we have learned, the assets are classified into non-current assets and current assets. Today we shall start our discussion on the items coming under non-current assets. The non-current assets consist of one, fixed assets, non-current investments, deferred tax asset, long-term loans and advances, other non-current assets. So under non-current assets, we have broadly 5 items. 5 heads are there. They are starting from fixed assets till it ends on other non-current assets. Now the fixed assets is again subdivided into 4 categories. Let us see what are they. Fixed assets are classified into tangible assets, intangible assets, capital work in progress, and intangible assets under development. Let us now start our discussion on fixed assets first. Fixed assets, tangible assets. That is what the first one which we are going to understand. Tangible means anything which we can feel and touch. That is the definition for intangible. Tangible means we can touch and feel. Fixed assets are those assets that are permanent or semi-permanent in nature. They are used for assisting production or for carrying on the business but are not consumed in the process. Fixed assets are also called capital assets. The example for fixed assets are land, building, plant and machinery, furniture and fixtures, vehicles, office equipments, computer, etc., etc., which are required for carrying on the business activity, but they are not consumed. Their benefit will be available for a period exceeding 1 year. They are known as capital assets also. The Schedule 3 of the Companies Act 2013 stipulates that the fixed assets should be reported in the following manner in the balance sheet prepared by the company. 1. Gross block less accumulated depreciation. 3. Net block. 4. Capital work in progress. Gross block means the cost of acquisition. That is what is called gross block. cost of acquisition at the time of purchasing that asset, what is the amount the company had paid together with the cost of transportation, cost of installation, etc., which are spent to make that asset usable. Now the depreciation is deducted. What you get is a net block or book value, that is depreciated value of that asset. And to that, we add what is called capital work in progress. We will come to that later. Now, the second requirement of the Schedule 3 of the Companies Act 2013 says a reconciliation of the gross and net carrying amount of each class of assets at the beginning and at the reporting period, showing additions, disposals, acquisitions through business combinations and other adjustment, and the related depreciation and impairment losses reversals shall be disclosed separately. Which means the company had to reconcile at the beginning of the year what was my gross block position, what are the capital assets or fixed assets I have added during that period, what are the capital assets or fixed assets I have disposed of, and what is the net position. This is in addition to reporting the gross block less accumulated depreciation, net block, and capital work in progress. I have given here an example of a company's balance sheet for 4 years. The gross block shows 138.80 is slightly increased to 139.03, further increased to 174.74, then increased to 201.01. That means the company had added a certain fixed assets every year. Then the depreciation is shown, which is an accumulated depreciation. That is the depreciation right from the day of acquiring that particular asset till date. Then return on value or the book value is the difference between these two. And the capital work in progress is 801 increased to 5084, reduced to 16.02, and then has become 0. Capital work in progress is an incompleted capital asset. It is undergoing the process of completing, but not completed. We will see that later. Now look here. The second requirement of the Schedule 3 of the Companies Act is to start with the opening stock and end at the closing stock, giving details of additions and disposals. Here if you look at 137.74 during that period, that is from 2001-4-2012 to 31-3-2013, the company added machinery worth 140 and disposed of machineries for 34. It could be either unusable or it have already run its life, they are selling it, and gross block at the end. And the gross block at the end will be the opening for the next year. Added additions worth 23, but there was no disposal. So the closing balance was 139.03. That becomes the opening balance for 2014-15. Added machinery was 36.38, deducted 67, ending at 174.74. Again during the year 2015-16, added 26.27, nothing is disposed of, ending with 201.01. Now look at the capital work in progress. That is, capital work in progress is incomplete and some work is going on. Say for example, a building under construction, 801, it has increased to 5084 and reduced to 1602. And that reduction is the difference between 5084 and 1602 is getting added to the gross block. That is, once it is completed, that part of the work in progress, that is capital work in progress, will get added to the gross block of the fixed assets. Now 1602 was a leftover that got added to that 174.74, that is included within the 26.27. So it has become 0 in the next year. Now, having understood the tangible fixed assets, let us now understand the intangible assets. Schedule 3 of the Companies Act 2013 classifies all intangible assets as fixed assets. This is one change which had happened in the Companies Act 2013. An intangible asset should satisfy the following conditions. Suppose somebody wants to classify an item as an intangible asset, the following conditions, the 4 conditions need to be satisfied. 1, it is identifiable. It must be a non-monetary asset. Control of asset is with the enterprise. Future economic benefits are expected to flow from such assets. Subject to compliance of these 4 conditions, an asset can be classified as an intangible asset. Now let us understand the examples of intangible assets. They are goodwill, brand or trademarks, computer software, mining rights, copyrights and patents, licenses and franchises, etc. are examples for intangible assets. Now let us understand what exactly is a capital work in progress. Capital work in progress is referred to as assets under constructions. It is an asset on the balance sheet that is not considered to be a final product, but must still be accounted for because funds have been invested towards its installation or completion. Depreciation cannot be charged on capital work in progress. Examples could be a machinery under installation. Machinery has come, but it has not made operational. Some installation work, also creating some bed to install it. The work is going on, so it is called a capital work in progress. A building under construction, a company is constructing a factory building. The building is not completed when the balance sheet is drawn. Still the construction is going on, but the company had already spent some money on that. So naturally, it should be reflected in the balance sheet. Now we look here. These company's sources are, see, capital is 2612, term loan is 7837, and it has got an unsecured loan of 800. The total liabilities is 11249. Fixed assets is 104,448. That is gross block. Or the capital work in progress stands separately because it cannot be depreciated. Because the fund has already come by way of unsecured loan, and having brought in that money as a source, naturally on the asset side it should reflect. That is why the capital work in progress is shown separately, because it cannot be depreciated, but it has to appear on the asset side for the simple reason that the company had already incurred some expenses on that, and the money is spent on that, which appears as a source on the liability side. Now again coming back to this one, this is the which we have already seen, the gross block at the beginning, additions, disposals, gross block at the end, depreciation, return on value, additions in capital work in progress, less capitalized capital work in progress. So out of this 801, 4283, the addition has come, making the total capital work in progress to 5084, and there is 3482 is capitalized, leaving the capital work in progress at 1602. Now that 1602 is capitalized in 2015-16, making the capital work in progress to 0. This is how it appears in the balance sheet of a company and based on the Schedule 3 of the Companies Act. Now the fourth item is intangible assets under development. They are nothing but patents, intellectual property rights, etc., which are being developed by the company, which is not completed. That is why they are known as intangible assets under development. So we have 4 classes. One is the fixed assets tangible, and for it What is not completed appears as a capital work in progress. Second one is fixed assets intangible, and intangible assets under development. So there are four categories under fixed asset, and fixed asset is one of the non-current assets. Now let us move on to non-current investment. Let us first understand what exactly is investment. See, most of the companies make investment in securities such as bonds, shares, debentures, etc. That is not their main activity. It is not an investing company. The business enterprises may have surplus funds, which they decide to invest in securities or assets for earning some profit or gains. They do not want that money to be invested immediately in a fixed asset or in current assets. So what they are doing is, instead of keeping that fund as idle, they do invest in bonds, shares, debentures, etc. to earn some profit or interest or return by way of dividend. Now, companies also make investment in the shares, bonds, debentures of another company in which the former has some interest on long-term basis. Investment made by companies in their subsidiary companies is an example for this type of investment. The investments can be broadly classified into non-current investment and current investment. Though non-current investment means the intention of the company is to keep the investment for a period beyond 12 months. So only the non-current investments appear under non-current assets. The current investment will go to the current assets, which we will learn later. So if any investment which the company has made and the intention of the company is to keep it at least for a period of more than 12 months, it is classified as a non-current investment. Now, when it comes to the classification of the investments, it should be divided into two. One is trade investment and other investment. Let us understand what is meant by a trade investment, because the Schedule 3 of the Companies Act require this classification. Investment made by a company in shares or debentures of another company other than subsidiary, essentially to promote trade or business of the first company. That is, there is a trade relation between these two companies. When one company makes an investment in another company, which cannot be their subsidiary, but there exists a trade relations between these two companies, then such investments are known as trade investments. Any investments which is not a trade investment is classified under other investments. And the Schedule 3 of the Companies Act requires further classification of the investment as investment in property, investment in equity instruments, that is shares, investment in the preference shares, investment in the government securities, investments in the debentures on bonds, investment in mutual funds, investment in partnership firms as a capital, or any other non-current investment. So there are two classifications. One is the investments need to be classified as a trade investment and other investments. And again, investments has to be further classified as per this slide. Under each classification, details have to be given. The names of the bodies of corporate where the investments have been made. That is, whether it is a subsidiary, whether it is an associate, whether it is a joint venture, whether it is a controlled special purpose entities. Then the following details also have to be furnished: aggregate amount of the quoted investments and market value thereof, aggregate amount of unquoted investments, that there the market price is not available, aggregate provision for diminution in value of investment, in case there is a decrease in value more than what I have purchased, that amount has to be indicated. Now we shall proceed to the next item, that is long-term loans and advances. The long-term loans and advances have to be classified under capital advance, security deposits, loans and advances to related parties, other loans and advances. I will give you an example. Capital advances means the company wants to purchase a machinery and the supplier of the machinery have asked for an advance. Any advance given against purchase of a capital asset, an advance paid to the contractor, advance given to the supplier of a vehicle, they are all example for capital advances. They have to be classified under long-term loans and advances. It is not a current assets. It is a non-current asset. Second one is security deposits. The security deposits kept with the excise department or with the sales tax department or the GST department or with the electricity board, they are all coming under the classification of security deposits. So they have to be classified under long-term loans and advances under non-current liability. Then loans and advances to related parties. Related parties could be a director or to a group company or to an associate company or to a group firm, etc. Again, long-term loans and advances need to be further classified into secured, considered good, unsecured, considered good, doubtful. Secured means the company had taken a loan against that. Security against that. I'm sorry. The company had taken company is giving the loan, long-term loans and advances. So against which the company had taken a security, that will come under secured, considered, or secured, doubtful, whatever it may be. And loans and advances due by directors or other officers of the company or any of them either severally or jointly with any other persons, or amount due by firms or private companies respectively, in which any of the directors or a director should be separately stated. This classification is a new addition in the Companies Act 2013. Then comes the another item, other non-current assets. The other non-current assets are long-term trade receivables, including trade receivables on deferred credit terms. Say for example, I have executed a bulk order and sold the goods to a company, and the company is asking for time of say 18 months to make payment. So naturally it is a long-term trade receivable. Similarly, any other item which will not fit into any other heads come under other non-current assets. And long-term trade receivables again need to be subclassified as secured considered good, unsecured considered good, doubtful. And allowance for bad and doubtful debt shall be disclosed under the relevant heads in case you have made some provisions for that. With this, we have completed the non-current assets of a balance sheet. In my next video series 17.9, we shall continue our discussion on the same topic, company's balance sheet, and understand the current assets of a balance sheet. Subscribe to this channel to receive intimation on new videos. Press the like button and share the information with your friends. Thank you very much.